Welcome to Informed Investor. Firstly, let's give you a quick update about the markets. Yesterday, the Indian stock markets experienced a significant sell-off with both the Nifty and Sensex closing in the red. Investors collectively lost over 10 lakh crore as the markets reacted to various negative factors. However, today there is a slight recovery with the Nifty up by 0.5%. So why did the market fall? Firstly, there was a notable outflow of funds from foreign investors, with FIIs pulling out money. In fact, FIIs have pulled out 7,160 crore from the Indian equity markets so far in the month of January. The confirmation of HMPV cases in India has raised health concerns. Although the virus is not expected to have the same impact as COVID-19, it led to a knee-jerk reaction in the markets, thereby contributing to a bearish sentiment among investors. The Indian rupee has been under immense pressure and fell to a new record low of 85.83 against the dollar, which can negatively impact companies reliant on imports and increase costs for consumers. A weaker currency often leads to inflationary pressures, further dampening the market sentiment. Lastly, changes in Japan's interest rate policies have impacted global carry trades. Now let me explain this. Since Japan had kept interest rates nil or very low, it had given investors the opportunity to borrow and invest in overseas markets like the US, European markets where interest rates are slightly higher. As Japan rates interest rates, borrowing in yen becomes more expensive, leading to potential losses for investors who had leveraged these trades. This shift can create ripples across global markets, including India. Despite these challenges, today's market shows some resilience with 0.5% increase in Nifty. Now let's shift our attention to Oil and Natural Gas Corporation Limited, or ONGC, which is India's largest oil and natural gas producer, which has recently been in the spotlight due to significant brokerage upgrades, thereby leading to a surge in the share price today by around 5%. Now before we get into this, let's do a quick overview of ONGC. Founded in 1956 and headquartered in New Delhi, ONGC is a state-owned enterprise under the Ministry of Oil and Natural Gas in India. It plays a pivotal role in the country's energy landscape, being the largest producer of crude oil and natural gas. ONGC contributes around 70% of India's crude oil production and approximately 84% of its natural gas output. The company operates across the entire hydrocarbon value chain, including exploration and production, which is its upstream segment. ONGC then refines this crude oil through subsidiaries like the Mangalore Refinery and Petrochemicals Limited and Hindustan Petroleum Corporation Limited, supplying various petroleum products to domestic markets. Additionally, it is also involved in power generation and has a growing portfolio in renewable energy. Now talking about the financial performance, ONGC's financial performance has been a mixed bag in recent years. While it has consistently generated significant revenue, profitability has been impacted by factors like fluctuating global oil prices, government regulations, and operational challenges. Now, on a standalone basis, in the second quarter, the company reported revenue from operations that declined 3.6% year-on-year to 33,881 crore. Net profit rose an impressive 17% to 11,984 crores. Now, on the flip side, the consolidated performance was somewhat different. While revenues grew 7.3% in the second quarter of fiscal 25, net profit declined 38.9% to 9,878 crore, largely attributed to reduced profits from its subsidiaries like Hindustan Petroleum and Mangalore Refinery. Notably, ONGC offers an attractive dividend yield of around 6%, making it appealing to investors. Now let's talk about the most exciting thing that's happening to ONGC, which is the brokerage upgrades. Firstly, CLSA upgraded ONGC to high conviction outperform, raising its share price target to 360 rupees per share, indicating an upside potential of around 42%. The brokerage cited multiple triggers for this bullish outlook. Anticipated production increases from ONGC's eastern offshore field could boost domestic oil output by 10% and gas output by 20% by the year end. The potential removal of windfall taxes may allow ONGC to achieve higher realizations if crude prices recover above the $75 per barrel. CLSA noted that ONGC is currently trading at a discount compared to its historical valuations and those of its peers. Secondly, Jefferies, another brokerage house, recently reaffirmed its bullish stance on ONGC, maintaining a buy rating with a revised price target of 375 rupees per share, indicating a potential upside of approximately 52% from current levels. Jefferies noted that the 30% correction in ONGC stock over the past 3 months appears overdone, and this presents a buying opportunity in the stock. The brokerage also expects Hindustan Petroleum's improved earnings to boost ONGC's consolidated EPS. Lastly, Jefferies sees ONGC's Krishna Godavari Basin production boost in the fourth quarter of fiscal 25 and the first quarter of fiscal 26. This ramp up in production could contribute 10% to ONGC's consolidated EBITDA in fiscal 26, making a critical driver for future stock performance. Now, to conclude, while recent brokerage's upgrades paints a positive picture for ONGC, it's important to acknowledge the challenges that lie ahead. Global geopolitical tensions can significantly impact the oil prices and the overall energy landscape. The energy sector is constantly evolving, and ONGC needs to adapt to new technologies and remain competitive. The company's operations are subject to various government regulations which can impact profitability. Having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.